about $1 billion in assets in the 90s, sold out, and then started a hedge fund as I was going into college. I joined the firm, family business outside of once I graduated, right? And long story short, the business folded in 2008. My father had passed away, and kind of had to reinvent myself. So had a stint with a family office for about a year, then joined another RIA, and through a combination of hard work and luck, and the two are related. Was able to kind of build somewhat of a name in the industry over the last 9 years, constantly putting content out there, getting it right sometimes, getting it wrong many other times, as no one can predict the future. But I'm certainly thankful for the opportunities I think that social media has given, right, in the sense that it's allowed for me to control the audience in the sense of putting my content out there so it's not just dependent upon the big media players that everyone sees. I do apologize. I'm actually trying to, 1 second. The joys of being live, I have to plug my laptop in.
That's okay.
Give me 1 second, everyone. I apologize. There we go. It's good to be unpolished. So anyway, shall we continue?
Yeah. So no, it's been super interesting. I mean, market was making new highs earlier this year in January, and then February, the market hits all-time highs. And then we start seeing reports about the coronavirus, and all of a sudden, there's some reports about how some of the cases are making it to the U.S. and the markets take a little bit of a dip. But then all of a sudden, mid-March, some of these governors, some of the state officials start talking about closing down the economy. And I go to work on Thursday, I think it was March 12th or 13th. And then we were supposed to go to Chicago that weekend just for a fun trip. And right before I left work, they said the Ohio governor just closed schools down for the next 2 weeks.
Yeah.
I was like, what just happened? What's going on with the markets? What's going on with the economy? What's going on out there? And that weekend, I mean, I think we were pretty much all glued to the TV, just trying to figure out what was going on. And slowly but surely, things just started closing up. Apple announced that they were going to close down their stores. Disney was going to close down their parks for the next 2 weeks, 3 weeks. And people thought that in the next 2 or 3 weeks, it was going to be over. But it was nothing like that. And then the markets made pretty much a new low on, not a new low, but a low for the year on March 23rd, I think.
Right.
And it dipped, I think 36% by then, the S&P 500.
Yeah, it was a bloodbath, right?
Yeah, it was. I mean, those 10 days were just brutal. Looking at the accounts, so what was going on in your mind? I mean, what were you telling your clients?
So just give a little bit of context. So, I put this premium research service, the Lead Lag Report, out there, but I'm also a portfolio manager of a mutual fund. The mutual fund is called the ATAC, which stands for a Tactical Rotation Fund. And just to give you a little bit of sort of context on philosophy, because it relates to the question, listen, this is a business where everyone needs to forecast to some extent, but the harsh reality is nobody can forecast a damn thing. Yogi Berra once said that predicting is hard, especially about the future. The best you can do is try to identify conditions under which something is likely to occur. Conditions dictate probabilities, probabilities dictate outcome, right? But you have to start with conditions first. Now, the way this year played out, I think, is really quite instructive on that point about conditions. And I say this from the standpoint of somebody who got the risk off and risk on side right, quantitatively determining the very conditions that favored the risk off move as well as the risk on move. The fund that I run is up over 40% for the year because of identifying those conditions and the outcome coming from the probabilities as a result. Mm-hmm. Now, mid-January, two of the main indicators that I often write about and track that I've documented in award-winning white papers started flashing a warning sign. Mm-hmm. These papers that I co-authored, I presented on all over the country. Essentially, the findings are that when the utility sector, the most boring sector of the stock market, is outperforming the broader stock market, generally on a short-term basis, you tend to see stock market volatility rise afterwards with a lag. So utilities typically move first, then you have higher risk periods going forward. One of the stats in the paper shows that in the top 1% of VIX spikes, those real collapses in equities, historically utilities are already leading 83% of the time. And we had a top 1% VIX spike in that period you just referenced.
Mm-hmm.
And it's not some random correlation, right? The causation there is around interest rates. Utilities are the most bond-like sector of the stock market. Their movement tells you a lot about changes in growth and inflation expectations. And you have the same kind of finding with treasuries too. When they're very long duration treasuries outperforming intermediate, a form of yield curve flattening, same kind of phenomenon. You tend to see stock market volatility rise afterwards with a lag. And factually, most major crashes, corrections, and bear markets are preceded by strength in utilities and treasuries. So if you take me at my word, this is a phenomenon, it's an anomaly that exists. The question is, how do you take advantage of it in terms of risk on, risk off? And how did it play out this year? So mid to late January, you started seeing some pickup in strength in utilities and treasuries.
Yeah.
Which is consistent with major declines for markets. Now, the market didn't care until late February, right? When it came to the coronavirus. And I was, putting out content saying, there's something strange here, right? There's some kind of defensive positioning happening at the margin. Now, a lot of people will say utilities and treasuries, how is it that they possibly could have predicted COVID? They couldn't have. But there was something that was bothering the marketplace. And the reality is COVID was not new when the market started collapsing. Meaning, if you looked on Twitter in December and January, there were all kinds of very strange videos coming out of China showing this army of people basically just disinfecting streets, which didn't seem to make sense with the idea that it's just a common cold. And there's this great expression in markets that nothing matters nothing matters, until it matters, and then when it does matter, it's the only thing that matters, right? So suddenly the market realized a month and a half later, after these signals sort of said, "Be careful," that it's time to go risk off. Now, the key to this, I think, the way that this has played out is this year so far, I hope at least, has been a reminder that there is risk with the return, right? And I think investors got so used to this incredibly smooth move, 45-degree line in markets since QE3, they forgot that volatility, when it happens very quickly. Now, of course, markets came back substantially, not all the way, unless you're the NASDAQ.
Right.
But I think that anybody that's been carefully watching this year probably needs to think about how to make their portfolios more robust to the potential that you get another risk off, another swing lower, which I think is going to be coming at some point, maybe sooner than later.
Mm-hmm. And then just backtracking it for a minute there, back in December, when the Chinese markets were starting to show some strange activity back then, and of course, some of these reports coming out of China, do you think that the U.S. got it wrong, like basically trying to, control what was going on, trying to shut down things back in March, or should they have done things earlier on to control the narrative? And not to mention, now it's kind of scary because we're seeing more and more case numbers. Of course, as more testing goes on, case numbers are going to go up. That's a given. But, should we have done things differently back then to control some of this from happening?
So look, I don't like to get political with stuff. I really don't. I am a big believer in psychology, behavior, and I think in reality, it's always a lot easier with hindsight to say this should have been done or that should have been done. That's not to say that mistakes were not made, but I have somewhat of an issue with the idea that look at how the administration behaved and how we could have saved all of these lives. That's easy to say with hindsight. Nobody really knew anything about this virus at the very start.
Right.
So this is just a purely apolitical type of way of looking at things, right? Now, I do think that you have this kind of interesting dichotomy or whatever difference between the way other countries, which arguably are more authoritarian, can handle a pandemic versus Western economies where there's democracy, freedom of speech, and sort of differing opinions. You can disagree with we can disagree all we want about the data in China as far as the viruses and infections, and probably a lot of it really isn't real. It's probably a lot higher than they're reporting. But China can literally order people to stay at home and force them to. It's very hard to do that in the States, right? When you're an emerging economy that's more authoritarian, you can dictate the society to do what is, arguably necessary to prevent the spread of an infection. It's very hard to do that in the U.S. because you've got states having their own power, the federal side having its own power, And now we're starting to see sort of the problems with sort of a lack of a unified response across all 50 states, given that now you're seeing us pick up in Texas, you're seeing us pick up in Arizona and Florida, right? This kind of almost piecemeal response that's not standardized across the board. So, I want to be careful playing the hindsight game with that, but I do think that, as I've said before when being interviewed about this topic, to me, this feels like a home construction project, right? It's going to take longer and cost more money than anybody thinks.
Yeah.
And I thought, and it's funny, right? So people, it's like you can play with semantics with this, right? Is it the second wave, or is it just a continuation of the first wave? It doesn't matter. It's here. Let's not keep on sort of thinking in terms of these kind of myopic ways of viewing the virus. We have to find a way to somewhat live with it and try to contain it until there is a vaccine, which hopefully does come, sometime next year.
Talk to me a little bit about, what's going to happen with the economy in the sense that, we're talking about unemployment rate, which is probably a lot higher than it's reported. The Fed's printing money like that there's no tomorrow. As the biggest economy in the world, yes, we have the leeway to print as much as possible, but there has to be some kind of limitation to that. Yeah, all the foreign investment can keep on continuing to come to the U.S. I mean, that's the counter argument, is that because we have the biggest economy in the world, the money that all this money that people have in cash is still going to flow into the U.S. markets. But where does it stop? I mean, where does, when you look at the balance sheet of many companies out there now, from small caps to mid caps to large caps, growth value companies, I mean, they have so much debt on their balance sheets, and how much debt they've taken on now.
I mean, it's a phenomenon that's not just U.S. based too, right? I mean, talking about a global sort of situation where debt is incredible pretty much everywhere. Emerging economies a little bit less so, although China's obviously very, very high too. Listen, I don't think this is an underappreciated fact about the environment that we're in. I think this is a very underappreciated fact. In other words, that everyone is kind of going about their day-to-day lives and, nervous about the pandemic, and, that will get resolved. But the bigger question is, how do we resolve all this debt? Now, there are two schools of thought. One is that you're either going to have hyperinflation to make that debt worth less, which I think is hard to do for a lot of reasons structurally in terms of the economy, or you're going to have what I think is the end game, which may be starting here, which is everyone defaults to the Fed, which is effectively what they call the debt jubilee, meaning that, all this debt gets forgiven and that you kind of have a bit of a reset on the financial system. That has its problems as well, right? Because if you were to forgive all this debt, who knows what that means for the dollar as the reserve currency. So it is very problematic, and it's now, I mean, look, again, we couldn't pay off our debt before this. There's no way we can pay it after this. It is a very concerning aspect, and the only real answer to it is either significant growth, which is hard to try to get, right, or austerity, which would send the economy probably into recession or depression. Right. So what do you do about it as an investor? I mean, I think the best thing to do is just try to have as many mixes of investments as possible in a portfolio that have exposures to different future paths, because we don't know which of those scenarios, hyperinflation or defaulting to the Fed, are going to play out. The reason I think defaulting to the Fed is kind of the ultimate end game is because you're starting to see it, meaning the pandemic gave the Fed the authority in some ways, or maybe misguided authority, to buy up munis, buy up corporates, buy up junk debt. They went from lender of last resort to the sole lender, in terms of the way I think this is playing out. So it is a very big problem. You can't tax your way out of it. Yeah, you can say, well, we'll tax the wealthy and that will take care of it. I don't even think that's plausible. So it's hard to kind of really figure out, debt historically is perceived as inflationary, but only up to a point. When if you have too much debt, then it's deflationary, which is why you can't really ever have high interest rates, because you have to service that debt with those higher interest rates. And if you don't have money to do so, then it's the Japan trap.
Right. Well, and you talked about that in your most recent article, that, the Fed's obviously planning on keeping the rates low until 2021, maybe even 2022. But and that's a big burden on the banks, because banks need the rates to be a little bit higher to sustain. And the stress test wasn't really the prettiest. There are banks that have a lot of capital, but that's going to evaporate so quickly, if the default rates start to go up. And, yeah, I understand that there are, rules and all this kind of stuff about how 30% of the people didn't make their mortgage payments or some kind of housing payment in May and June and April. But that's gonna, I think people don't realize that it's not that those payments are forgiven. You still have to make those payments come July, August, September, and also make payments for those months. So, are we going to start seeing that snowball effect where the default rates start to go up and individual people will say like, look, I can't afford this housing payment anymore. I got to get out of this, or I got to sell my house. I mean, that's a huge burden on some of these banks.
Yeah, I don't know if you're going to see that this year because it's an election year, and I tend to be pretty cynical in terms of how policy, those in power want to stay in power, which means if they have to keep on doing another payment protection program or doing more stimulus, they're going to keep doing it. Yeah. That's also kind of the thing, which I think is part of the calculation here, right? Everyone, the fiscal and monetary side are both pot committed, right? Meaning that they've already done so much that they're going to keep doing more and more to try and just buy time, right? For everyone and for themselves, quite frankly, until the vaccine is there, until maybe the economy can pick up. So, look, and I think that kind of goes into the issue of short-term versus long-term inflation or deflation. Right, so I've been making the case, more recently that you have this kind of very strange setup where, on the surface, staying at home is deflationary. Mm-hmm. Yet, right, a lot of people that have been unemployed throughout this have been making more money because of the government transfer checks, because of unemployment checks. Mm-hmm. So you have a lot of money kind of going through the system, right? Maybe an overreaction to the pandemic because of that. So consumer spending power actually has been not that bad, as bad as you might think, obviously. Right. And then you've got, this kind of supply disruption. You've got hoarding. You've got too much money chasing too few goods definitionally. So you going back to even the banks, right? The banks may end up actually being okay if the yield curve were to steepen, right? Because that's how they can make some of their extra profit on the net interest margin, the difference between long and short rates in terms of lending and borrowing. And I've made this case before that, I think the best thing to do in some ways, as much as it sounds bizarre, is to try to actually scare the market into thinking that rates will rise. Mm-hmm. Right? Look, the problem for the Fed all along has never been the amount of money. Right? They've always wanted to achieve sort of consistent inflation to try to inflate away debt. The problem has never been the amount of money. It's about the psychology. It's about the velocity of money. It's about the speed with which transactions take place. And if you create an environment where everyone thinks that rates will forever be low and they anchor onto a year like 2021 or 2022, what's the urgency to borrow? What's the urgency to buy a new house and lock in a low mortgage rate?
Very true.
I think there's a psychology element to this which is being missed. That in many ways, if you really want to create inflation, you've got to get the velocity of money picking up, which means you probably have to scare the public into thinking rates are going to be higher and the things will be more expensive. Now that seems, in terms of the cost of capital, that seems strange, right? Because I'm basically advocating that the Fed maybe should tighten liquidity. I'm not advocating that the Fed tighten liquidity unless that tightening of liquidity creates an increase in the amount of people transacting. Mm-hmm. I think from that standpoint, that will be beneficial for banks, beneficial maybe for the system. Listen, at this rate, I don't see how they're going to ever even think about raising rates, even though that may be what's ultimately better for the economy.
So what if the Fed keeps on printing money, at what point can they really say, we can't go on any longer? I mean, is there like a stopping point out there?
I mean, they seem to think there isn't, right? I mean, there have been a number of these Fed spokesmen, Fed governors saying, listen, we can just print from now until kingdom come. And quite honestly, they can. I mean, that's kind of in their charter. It's not a coincidence that the debt exploded and balance sheets exploded and all this exploded once we got off the gold standard, right? Because what ended up happening is once you got out of the gold standard, which was a form of discipline for monetary liquidity, well, if you don't have discipline, then you're never going to have a reason to sort of force rates higher. The bias is always going to be for cheaper credit. Right. I remember Greenspan once made that point many years ago, saying, he never, when he was Fed chair, got a senator or a president saying you should raise rates. Right. There's always a bias towards cheaper credit. Keep borrowing. And again, that works until it doesn't, because at some point there's the whole pushing on a string adage, right? Which is that you keep on adding more debt to fix the deflation problem, and actually makes deflation worse longer term.
It does.
I think that's sort of this dilemma that all central banks are in this, what I would argue is still kind of an experiment of capitalism. This is something that I think is an interesting sort of thought construct, right? The people who are big believers in buy and hold will say, look at the last 100 years, right? Stocks go up in the U.S. I guess the question that I would go to there is, well, is the last 100 years an anomaly in terms of civilization, in terms of progress as a human race, in terms of growth, right? In terms of all the things that we are living in, right? Is 100 years really a sort of large enough sample size to make a definitive statement that stocks will go up for the long term? It certainly wasn't for Japan. It wasn't for a lot of other countries in Europe. And given that capitalism arguably is still an experiment in the sense that it's only been around for, it's not like it's been around since before the time of Jesus, right? I mean, this is a fairly new phenomenon in the context of centuries of human civilization. I do wonder, right, if we're going to see a completely different system coming out of this, because there's going to be a realization that there's just too much damn debt. Different system coming out of this because there's going to be a realization that there's just too much damn debt.
So, can you hear me okay?
Yeah, you're good. There was a little bit of lag there.
Yeah. So one of the questions then that comes up is with the markets, right? Like it always kind of boggles my mind when we think about is the 100-year period long enough? And to me, it doesn't seem like it is, because if an average investor is supposed to invest for 30, 40 years, that's really just like what, 2 cycles, essentially, right. two and a half cycles. If an average investor is supposed to invest for 30, 40 years.
Yeah, and it seems like there's going to lag maybe on your end, but yeah, no, that's correct, right? I mean, and I always make this point, right? We live in the small sample. Yeah. And you're right, the average lifespan would indicate that you only really have 2 cycles.
Should we be looking at more of a 20, 25-year horizon to basically really try to figure out like what the returns have been over the last 20 years? If you factor in the crash of 2000, 2001 and the current economic cycle, then the returns aren't really what the media tells you, 11, 12% a year. They're a lot lower.
Yeah, no, exactly. Well, actually, even I'll take it even a bit further, right? The notion that annualized returns are some number all depends on your starting point, right? Your annualized returns look a lot better if you bought in March 09. They don't look a lot better necessarily when you compare it to some other starting point, right? I mean, you can always play around with sort of the start date for a lot of this stuff and make any case you want. So a good example of that is gold prices. Right, gold since 2000 has done really, really well, and as I recall, still is outperforming. I think the S&P. I could be wrong on that, but certainly hasn't been the case. It's certainly underperformed for the last 5-10 years or so. Right, so it's all about where your starting point is, and it kind of goes back to this point that the best thing I think any investor can do is have as many different strategies in their portfolio. I run a very specific one, the ATAC rotation fund, risk on, risk off, done fantastic this year so far, up again over 40%. Mm-hmm. But that's only one part of a potential allocation, right? Having things like gold, Bitcoin, stocks, bonds, managed futures, because you don't know which future is going to hit, makes the most sense. Mm-hmm. That way, independent of the 2 cycles that somebody has to live through, from now until they have to live off their assets, because you don't know how it's going to play out. You might as well have as many different things as possible.
Yeah. Well, tell me like a little bit about that strategy that you're talking about. The risk on, risk off. I mean, what were some of the things you did differently back all this started happening? You talked to your clients about, okay, these are the changes that we have to make. What was the strategy like? I mean, what kind of conversations were you having with them?
Yeah, so look, everything I do is quantitative in nature, so it's not based on opinion. As much as I do a lot of writings, I'm just giving voice to math, right? Again, mid-January, the signals, utilities and treasuries in particular, which are historically risk-off indicators, said be careful. They went risk-on first week of April, so the fund was able to get both the risk-off and risk-on side right, which is why it's doing quite well this year. I've always needed, and I think this is kind of the thing for most tactical traders and investors, you still need a cycle, right, that favors what you're doing.
Yeah.
If you were in a cycle like the mid 90s or like the post QE3 period, purely up and to the right, that's tough, right? Because if your strategy thrives on avoiding big declines, there have to be some big declines to avoid, right? And if you're in a pure unrelenting bull market, you're better off being just all in, Vanguard, cheap beta, and just close your eyes.
Mm-hmm.
If you're in an environment where there are more swings, that's where kind of having more diversifiers, more tactical strategies kind of work. Now, for a lot of reasons, I think we're in this environment of swings for a while. And I'm not saying that from a self-serving perspective. I'm saying that because the reality is, whenever you hear the media say risk on and risk off,
Mm-hmm.
risk on, risk off is just another way of saying inflation, deflation.
Yeah.
Right? Risk on means inflationary assets rise, risk assets, stocks. Risk off means treasuries, rise in price, drop in yield. So from that standpoint, because again, we have so much debt in the system, I'll make the case that the only question that matters, for our generation, for kids' generations, whatever, is it going to be inflation or deflation? Going back to that point about the sheer amount of debt in the system. So
Mm-hmm.
I think you're going to keep on having these swings because the market is going to have to wrestle with sort of the facts on the ground versus policymakers doing everything they can to try to jam inflation higher.
Right.
So, and also whether they can control the narrative as well.
Do we need what's a healthy inflation that we need to really sustain, the growth in this country and really worldwide?
Yeah, I mean, it's a good question. I think, first of all, we should take a step back because some people will say, correctly so, that inflation is higher than the reported numbers.
Right.
There's a lot of ways of defining inflation, right? I think what we really need is wage inflation,
Mm-hmm.
right, as opposed to inflation in food and sort of demand pull versus cost push, right?
Mm-hmm.
Now it's hard to get, and this is why I tend to be much more of a deflationist in my thinking longer term. It's hard to get inflation as defined by wages higher in the context of three mega trends, right?
Mm-hmm.
One is the one that we all know, which is demographics. There's a great stat that in Japan more people buy diapers for older people than for babies, right? Because the aging population has and sort of lack of new entrants with a younger age, right, is countering some of the inflationary potential that youth can bring. And that's also not just a Japan phenomenon, that's a developed markets phenomenon. So demographics are disinflationary, deflationary. That's not going away anytime soon. I used to joke that if you really want to get inflation going, you should ban contraceptives, right? Because you just force people to have babies, which is not going to happen, but in practice is sort of, I think, one of the ways it could be done. Technology is obviously very disinflationary.
Yeah.
Right. So, if you don't believe me, just pull up on YouTube one of those videos of Tesla factories, right, making cars without a single person. Right? It's all machines making machines.
Yeah.
And then, of course, the wealth gap is deflationary. I'm sorry, but Zuckerberg from Facebook doesn't need 2 airplanes.
Right.
Right. I mean, you can't get the velocity of money going unless you have more people having money in their pocket instead of a concentrated percentage of the population that has most of the wealth. Again, those are all mega trends that have been in place for a while. So it's hard to see sort of any sort of wage inflation to get us to that growth number that you referenced to that's consistent, because how do you do it? You'd almost have to be a Luddite, meaning counter technology, and almost have to be socialist in terms of taxing the very rich over and over and over again to bring them down to everybody else. That's hard to do. Right. So that's why I'm much more sort of negative longer term on sort of the state of the system
Mm-hmm.
from that standpoint.
And then, so what happens to, let's just talk about like the general public. Like you want to invest for the future. You want to talk about like asset diversification and that kind of stuff. So when people talk about those kind of things, they're meeting with their advisors. They're doing some of the investing on their own. I mean, well, one of the things to kind of, I guess, sidetracked with this whole, the Robin Hood theory, right? That there's so much money that's being thrown out there in the retail investing world right now that's causing some of the volatility in the markets. But generally speaking, I mean, that might not be the healthiest thing. When people go back to work, they're not going to have time to do this day trading and trend trading and that kind of stuff.
You mean gambling?
What happens to the asset diversification? Like if I were to start looking into investing today, what are my options? What do I do with my money?
Yeah, and this is the challenge for everybody, right? So, look, the old construct for most portfolios is what they call a 60-40 portfolio, right?
Right.
60% stocks, 40% bonds. And usually you own bonds really because you own stocks, right? It's meant to sort of cushion, big pockets, air pockets that happen in equities when they go down, so your bonds can cushion your overall volatility. Problem is that you're taking the bond portion out of the equation now, right? Because the Fed is buying up corporates, buying up munis,
Mm.
buying up junk. I was ranting for a bit when the Fed announced they were doing all that because they literally stole investor returns, in the midst of that decline. It's not like in the midst of March, towards the low, that every single company was going to go default, right? You were in a capitulation stage where there were some really nice yields you could have positioned the bond portion of your portfolio in, but the Fed just decided to be the only one to come in and aggressively buy them up,
Right.
right? So the Fed did steal returns. I mean, let's not call it any other thing, at least in the bond market. So, and if you go back to sort of my original thought construct, which is that you either have hyperinflation or default, that doesn't sound good for bonds at all.
Right.
Right? Because the extremes, in both extremes, that's terrible, right? So I think from an investor standpoint, the way to view it is not diversification of asset class, but really diversification of strategies,
Hmm.
right? Um, the reality is we live in a risk on, risk off paradigm, meaning that most things correlate to equities. Most
Right.
things. Those that do not correlate to equities have had a hard time really standing out because equities have been the only game in town. Beta's been the only game in town. And
Right.
everyone's lived under this mantra of, don't fight the Fed. If you really want to kind of think about how do you create a more anti-fragile, more robust, and I know the two terms are not exactly the same,
Yeah.
portfolio, again, you've got to have a mix of different things. Gold, things that are not correlated, right? And not correlated means, things which kind of march to their own beat, right? Gold is a good example. When I was on the road, I used to always ask advisors, tell me about a portion of your portfolio that you hate. I don't really hate any portion of my portfolio. Then by definition, you are not diversifying your client's assets.
Right.
Because what's diversification? It's a mixture of things which are not correlated, which means things that move in different ways at different times.
Hmm.
And what's the portion of the portfolio that you're going to hate? It's the portion that is not making money when other portions of your portfolio are making money. And yet
Exactly.
that's exactly what diversification is, having parts of your portfolio that quote unquote aren't working because the cycle for whatever reason isn't favoring it, but that's exactly how you get a non-correlated return stream
Right.
internally in a portfolio. So things like gold, cryptos, I think kind of makes some sense to provide that diversification. And I'm not talking about from a core allocation standpoint, 5-10% range. Same thing with ATAC,
Yeah.
my mutual fund, right? It's really about, it's not about sort of the way of thinking about things in terms of what's cheap. It's about what's moving differently.
Right.
I think that's how most people really have to think longer term.
Which makes sense. I mean, at the end of the day, what you see a lot out there is that this fund or that fund has outperformed the market by this many percentage points and all that kind of stuff. And a lot of it is the trend is in their favor, which makes sense, but that's not really the right strategy for an investor long term, because what's working today, I mean, I can't imagine some of these fintech stocks that are up over 100%, and a pretty big group. I mean, 15, 20 stocks that are up over 100% since the March lows
Sure.
continue to move up. But I can't imagine that kind of growth continuing to take place into next year. I mean, how is that even justified?
Well,
Like,
but as we know, I mean, it can continue
like
as we know.
DocuSign,
Right.
Zoom, Shopify. I mean, some of these stocks are up 200, 300%.
Yeah, I mean, look, I always use this example, right? And yes, it's cliche to say, markets stay irrational longer than you can stay solvent. That,
Yeah.
of course, assumes that you're shorting, right? That saying never doesn't make sense actually when you take out the shorting aspect of it because you can just avoid it. And I always use this as example, when Greenspan said irrational exuberance, he was right,
Yeah.
but he was right 4 years early. All right. So my point is that these things can last a lot longer than you think. These disconnects.
Right.
That doesn't mean that you should necessarily not try to play it. I mean, if you really want to be active and tactical, sure, might as well play the bubble when it's there.
Yeah.
But I think that that's a very hard game to play. And for true investors, you probably want to take out that noise and think much, much longer term. Listen, all these companies might have fantastic, services, but unless they actually make money, then you're just it's a fool's game. Meaning you're just buying because everyone else is buying. And again, that can work until it doesn't.
Yeah. Yep, I agree. Now, yesterday was super interesting, for a lot of the social media companies, especially Facebook, where, companies like Verizon and Procter & Gamble talked about dropping them as one of their ad mediums. What are your thoughts on what that future looks like? And I know we don't necessarily want to get too political with all this, but it is a valid concern for, the markets in terms of like how that portion of the social governance for some of these companies will lie and how that's going to affect their performance in the marketplace.
Yeah, I mean, look, it's I think it's extremely complex, the entire situation, right? Because yes, Facebook arguably should be filtering out, a lot of this hate speech.
Mm-hmm.
But when you do that, then you also, I think, put a burden on smaller companies that are trying to maybe be the next Facebook
Mm-hmm.
to do that when they don't have the resources to.
Mm-hmm.
Right. And so now some people will say that, it doesn't matter, it has to be done, but it's one of those things where if you add kind of compliance and regulatory costs, which is what that would do, right? Cost to the bottom line of the consumer, to the company, it gives the consumer less choices.
Yeah.
It actually then centralizes more power to Facebook, right? Because the smaller platform can't possibly do then what Facebook is being asked to do now. So that's what I'm saying. It's very complex, right? It's hard for me to sort of really definitively say one way or the other, this is what Facebook should do, because, one, I don't know all the intricacies, obviously, but I keep going back to how do you promote competition,
Mm-hmm.
In any space. It's with less regulatory cost.
Right.
So, now as far as all these advertisers that are pointing out, look, I mean, there are other avenues they can use, Snapchat, Twitter, Google. I mean, there's a lot of other ways, you use traditional billboards if people are still driving
Mm-hmm.
in an era of pandemics. But look, in general, right, I mean, keep in mind, I mean, some of this may just be sort of bluster by advertisers, right? In the sense that I just put a tweet out not too long ago that the ad spending across the board has collapsed anyway.
Right.
Which makes sense because, what's the first thing to go in a recession? It's ad spending.
Right.
So you're still in a recession. So some of these companies are saying, well, okay, this is a good excuse for us to just not advertise. But I also partially kind of question the motivations of some of these companies in pulling out, because they might be pulling out regardless, right? And this just becomes a catalyst to some extent.
Yeah. Do you think that, looking ahead 6 to 12 months from now, are we going to see, of course, like there's that fear of that second wave. I mean, of course, like this doesn't even look like a second wave. I mean, this is just almost like a continuation of the first wave. Now that we're seeing more case numbers, and that's becoming, a little bit of worrisome for a lot of businesses, and including mine. I mean, I own a small a dental practice, and that's, you're always thinking about those kind of things. What's going to happen when there are more cases? But looking ahead, where there are still, millions of people out of jobs right now, are we going to continue to see that increase? I mean, are we going to see where the jobless claim numbers, I mean, the one that just came out on Thursday was, I think, another 1.5 million filed. I would have expected those numbers to drop sharply as the economy starts to open back up, but I haven't seen that. Like, I don't think, like, to me, that doesn't sound very normal at all. Like, that we're still seeing 1.5 million new claims that are just continuing to pile on. So what's your take on all this? Like, 6 to 12 months out, I mean, are we going to be in a better position, or are we going to be in a worse position from here on out?
Well, I mean, I think you hit the term correctly there, right? The reopening, and now I think the reopening is very much in question.
Yeah.
Right. I mean, listen, I'm in New York, right? I mean, we're reopening, and the cases have utterly collapsed here, and that's because we were very aggressive, and
Mm-hmm.
I think people took the mask argument much more seriously, to wear masks, right?
Mm-hmm.
And whereas in other states they may not have sort of the same, they see New York and they don't think it's as big of a problem for them until it does become a problem, right? So it's not a surprise, right, that you're going to have this kind of fits and starts to this.
Mm-hmm.
And that you're going to have sort of selective hotspots getting shut down while others, seemingly are kind of going back to somewhat normal.
Mm-hmm.
And that will impact obviously the hiring potential, right? Because again, yeah, you might have a plan. It's kind of like the old Mike Tyson saying, right? Everyone has a plan until they get punched in the mouth.
Right.
You might have these plans to reopen, but then something, the numbers come up much more aggressive than you think, and then suddenly, well, I guess we can't hire anymore. Right. So I think it's going to be very, very lumpy. And even when you get a vaccine, it's going to be very, very lumpy, because the reality is there will be some people that just either don't trust the vaccine.
Exactly.
Keep in mind too, right? We don't know. You get a vaccine, yes, there are strains, mutations that might occur. The vaccine may not be as safe as people think. So there might be some people that wait, even though a vaccine might be announced and readily available. Some people may wait to see if there are after effects that have not been caught in the data. So like I said, this is going to take time. And that's why I think to some extent, they can't stop the money printing.
Yeah.
Listen, South Korea was the first one to do this kind of giving of checks to people to stay home. The thing with that is once you set a precedent for it, it's hard to stop.
Yeah.
Right. So I suspect you're going to see more of this sort of, stimulus that goes directly to people's pockets. And you're going to have also politicians obviously politicize that, but I don't see any other way, to kind of buy time except to literally print money to buy it.
Exactly. Yeah. And that's tricky. I mean, just because, no one really knows the trajectory of everything that's going on right now. But if I were to ask you, let's say, by the end of the year, S&P 500, are we looking at higher than yesterday or lower?
I mean, I'll tell you in 2021. I don't know. I mean, and I say that because I really do stress this, right? No one knows the future. And this is the thing too. I talk to a lot of people that say, the problem with this environment is that it's more uncertain than ever before.
Yes.
I always kind of bang my head on the wall. It's always uncertain. I want to see your models for equities 2 years ago if they predicted, a COVID. Right, the future is always unknowable. Can be better, could be worse. Right, the only thing I can tell you about is the weather. Right, the conditions again, short term that favor an accident.
Yeah.
So would it surprise me? It would not surprise me if you make new highs on the SP. It wouldn't surprise me if you make new lows.
Yeah.
Because there's so many different paths that this can play out under.
Right.
Now, I do think though that having said all that, you have to kind of anticipate the anticipation of others. Right.
Mm-hmm. So
with every tick lower in equities, I think the odds increase pretty meaningfully that the Fed would either seek congressional approval to buy equities, or they text their central bank buddies and tell them to buy our stocks, which they're already doing, but they can work out a backdoor deal so that they do it more aggressively.
Right.
So if they need to keep on manipulating the shit out of this, they will.
Yeah, but that's
which makes me more on the sort of neutral, the bullish side than the bearish side.
Yeah, and that's kind of scary when you think about it. That that the Fed can buy stocks of individual companies out there, and it's almost kind of like, okay, is it really public owned at this point now? No, it's partly government owned.
Yeah, no, I think that's right, and I don't see how that's going to change. Now, some people will say that that's bearish if you go to that extreme, because look at Japan. Right? A Bank of Japan, I think, owns 80% of the ETF assets, right? Mm-hmm. Because they've done exactly what the people are thinking the Fed will do, which is buy their own stocks.
Right.
Maybe it ends up being like Japan, maybe not. Right. I mean, the problem with all the scenarios where people say this is going to be like Japan and we're going to have this zero return environment is that it's a sample size of one. We just don't know, given the exact same circumstances, if the U.S. would act differently or not.
Right. And then there's, of course, that uncertainty that with the China trade deal, it was so funny last week on, I think it was, I forget, Sunday night or something, that it was announced that the China trade deal is in danger, and then literally 2-3 hours later that it's okay, nothing's going on, and the futures reversed and they were positive.
Yeah,
it just goes to show you that I guess I'm okay to call it manipulation in the markets that take place. I mean, on an hourly basis right now.
Listen, we live in a world where seemingly the truth changes every day.
Yeah, it does. So yeah, it's really interesting. I mean, everything that's been going on right now has just really, I think, shaken a lot of investors to the core to really figure out what their core strategy should be. I mean, do you think that assets like gold and Bitcoin, for example, should that be a must investment for everyone in terms of at least a portion of their portfolio?
I'm always hesitant to say must, right? Because must is a function of time frame.
Yeah.
Right. So, if you must, sell portion of your portfolio, to pay for expenses in the next couple of months, and you're going into a must asset or investment that's volatile, it's probably not a must. Right. So I think I'm just kind of giving some nuances to that. Listen. This sounds cliche, but I think the must thing to do with any investment is to just educate yourself in general, right? I think too many people spend time putting their money to work in trading because things are commission free rather than actually reading books on markets.
Yeah.
Right. You have a lot of people that are just, even day trading and they don't know a thing about how volatility works intraday.
You're right.
So they spend their money directly going into the fire rather than figuring out how to cook in the fire. Right.
Right. And
So
that the number of traders and number of people that claim to be chart experts on Twitter has like skyrocketed in the last 3 to 4 months.
yeah, it's I'd love to know if any of these so-called traders, first of all, what their actual profits are, what their risk is, how active they trade. Can you compare it against buy and hold? Is it based on gut feeling or quantitative? What studies have they looked at? Have they studied the 20s? Have they studied the 30s, the 40s, the 50s? All this stuff.
Yeah.
Listen, this is a very interesting domain in life, right? Because in this business, you can be wrong and make money, and you can be right and lose money.
Right.
And if you're making money and you're wrong, you're going to think it's because you're right.
Exactly.
Right? Rather than sort of the reality that there's probably a lot more randomness and noise and luck than most people want to give credit to. Right. And I think that kind of creates this sense of overconfidence among traders and creates an environment where people end up taking too much risk until they ultimately blow up.
Yeah, and that happens a lot in
That's
the
a problem.
casinos. It happens a lot in the casinos. You go there the first time and you make some money. You're like, wow, this is easy, and you continue to do so. And you go there for 3 to 4 days, and you're like, shit, I just lost a lot of money out there. So.
Yeah, and listen, I mean, I'm against the idea of people using stocks for that purpose because, listen, I mean, this is about what is the stock market? It's about a tell on the efficient allocation of capital.
Yeah.
Right. You're rewarding companies that are doing the right things and so that they're growing, and you're punishing those that don't. So,
but then don't you think?
Efficiency.
Then don't you think, in an essence, then ETFs become a problem because then you're buying, or ETFs or funds in general become a problem because you're buying a group of stocks, right? So you can have, let's say some bank ETF that has a bunch of good companies, maybe a bunch of bad companies, but then you're also rewarding the bad companies by buying up that ETF, or hurting the good companies by selling up the ETF when you should be holding on to those companies.
Well, this is kind of the issue with the cult of passive, right? Which is to say that exactly to your point, what happens is that you actually create other inefficiencies because you're not then within the index sort of doing capitalization adjustments because of active bets on growth or contraction. And this kind of the paradox about passive, right? You need passive for active to work. You need active for passive to work.
Yeah.
Meaning, if the pendulum swings so far to the extreme of market capitalization and passive investing, there are more undervalued opportunities and also more overvalued opportunities because everything's kind of moving in one kind of monolithic way.
Right.
That's where the active anomalies come in, and that's where real savvy active traders can conceivably benefit from that misallocation of capital that passive is driving. Now, at the same time, at some point, if there's too much active, there's not enough anomalies, so passive works again. Right. So you can't have one without the other. I do think the pendulum has swung so extreme because of ETFs in the direction of, in particular, market cap weighted passive strategies that yes, there should be more active opportunities, but not necessarily from what you see on Twitter.
Right. Yeah, and it's if you strip out the big 5 or 6 companies from the S&P, I mean, you realize that the S&P is so far behind than what it actually seems like. I mean, if you strip out Apple, Facebook, Microsoft, Amazon, Alphabet, it's actually a lot further. Some of these companies are still down like 20+%. Not some, actually, a lot of them are still down 20+% when you strip out those 5 or 6 companies out there. So it just kind of goes to show you that the weight some companies carry in the index is so big that it basically makes the index look a lot better than it actually is.
Yeah, I think that's right.
So, yeah, it's definitely interesting. I mean, same thing with NASDAQ. I mean, when it was making new highs, you've got this like group of stocks, maybe 20, 25 companies that are doing the right things, or basically, making the NASDAQ go into new highs and whatnot. So it's kind of like one of those things where you're investing, but you're not really kind of following your true beliefs at that point, because you're just kind of
chasing or whatever it may be. Yeah. Listen, it's like I said, this is not it seems easy, this business.
yeah.
It's a lot harder than people realize,
Yeah.
especially if you're going to be in it for the long term.
Yeah. So, like, as we wrap up, I want to talk about just, if let's say someone becomes a new client of yours, like, what would you tell them, like, in terms of, getting started? Like, do you say, like, hey, I want you to stay in cash? Like, if it's a new investor that wants to start investing at this point, do you stay in cash or do you start them somewhere? I mean, do you start them in some kind of funds, or what's the strategy, right now?
Yeah, no, so right. So I run a very specific mutual fund strategy, but in general, as it relates to sort of the idea of, what do you do here and now? I think the answer again goes back to time frame, right?
Yeah.
If you have an investor who's young and really doesn't need the money anytime soon, put money to work now.
Yeah.
Because honestly, it doesn't matter. Meaning, in 30 years, most likely you'll still make money, right?
Yeah.
Hopefully after inflation. If you need that money, shorter, over a shorter time frame, you got to be much more conservative, obviously, and something much more liquid. I think the problem is that people don't sort of think through the interaction of time frame and risk.
Yeah.
Right. So if you have a long time frame and you're young, you should not be watching markets day to day. You should not be making decisions on markets day to day. You should not be gambling on markets day to day, because it doesn't matter. What matters is that where you end and when you need the money, when you need to die. The kind of paradox about this is that the best time the way to think about investing is not about investing. It's about when you divest, right? It's when you take the money out.
I love that. Yeah.
Right, from a risk tolerance perspective. So, from that perspective, listen, every generation has had some kind of massive hurdle to overcome. Maybe this is ours, maybe it's not, maybe there's something bigger coming down the line. But at the end of the day, if you're thinking about how do you grow your capital, you're not going to do it by listening to the talking heads and reacting on every single tick in the markets. In the case of, when I do, it's short-term oriented, but it's a very specific anomaly and strategy I'm trying to execute on.
Right.
That has longer-term cycles that favor it, right? But for most investors that just need to, have something that's sort of more traditional, you have to ask the time frame question first. Everything really depends upon one's time frame.
And then, are you able to talk about your fund for a couple minutes? Just kind of tell us what kind of fund is it? What kind of investors are you looking for in that kind of stuff in your funds?
Yeah, so the fund is called the ATAC Rotation Fund, Atactical, which again I mentioned is up 40 some odd % for the year. It's
and that's
at least as of this discussion, it's up. It's quite literally the #1 fund in the country against most asset classes across multiple time frames, strategies. And it's not because I've been doing anything particularly special, right? The strategy is risk on, risk off, and it's using leading indicators to risk. What's happened is that the environment has started to favor risk on, risk off, which just means swings in markets, which allows for very aggressive rotations to, hopefully have a chance at working.
Yeah.
Most, advisors, investors put in the 5 to 10% range. It's more of a satellite type of strategy.
Yeah.
I mentioned before, right? I've put a lot of content out there. Times I've been right and times I've been wrong.
Yeah.
I think the key to this industry, I think it's a good way to kind of wrap this discussion up, right, is this idea that people get sucked into the idea that you need to have consistent returns, right? That you want frequency of consecutive up years, The reality is frequency matters a lot less than magnitude of returns, right?
Yeah.
And I think this year was a good example, right? All it took was, a month and a half to erase, whatever it was, 4 years of gains. You were consistently frequent in your returns for markets coming, out of the election. Yeah. And then suddenly the pandemic hits, and then where did all your returns go? Blink of an eye, right? So people, unfortunately, get too sucked into the desire to be right more often than wrong, rather than thinking about it's okay to be wrong a lot as long as when you're right, you're really, really right, right? Which is sort of tail risk investing, so to speak.
Yeah.
So from that standpoint, my fund has elements of that, meaning it's not meant to be a consistent return stream, because consistency is very much an illusion in markets. Right. It's really about trying to identify conditions that favor the accident. Listen, mathematically, if you can avoid a major decline for stocks, you don't make excess returns by being up more. It's actually by being down less. The
True.
problem is, I think a lot of investors forgot that because you had an environment of purely up and to the right. If down capture matters more than up capture, and we're in an environment where there's going to be more down capture, more downside, things like ATAC and again, things which are, tail risk type of strategies have a good chance at standing out, but it's going to be lumpy. And I think as long as you have a longer term time frame, it makes sense to allocate to strategies like mine, like others. I know that's self-serving, but it's more about sort of how you think about constructing a portfolio. It's not for getting the pennies, it's for getting the dollars.
Yeah. Yeah. I think that's so nice that you said that, because I feel like most people are not diversified enough, and they, once you get onto some kind of 60-40 fund, you don't, you just keep putting money in each month, every 2 weeks or whatever. But people are not diversified enough to really look at the investments besides the 60-40 funds out there.
Right.
That becomes a big problem because, like you just said, people are looking for that upside, and people don't realize that in down markets, well, if the market lost 35% and maybe you only lost 25%, you still came out ahead.
Huge. Yeah.
So
the math of it is very much against you with big declines. So
absolutely.
That's what you have to be most concerned about.
Yeah. Yeah, absolutely. This is actually a really good question because, earlier you were talking about books and reading and educating yourself. So this question is, if there's one book on investing to read and educate yourself, what would you recommend?
Yeah, look, I mean, I self-serving wise, I can say my father's book, Intermarket Analysis Investing. But I'll tell you that, for me, it's I'm a big fan of Nassim Taleb and the Black Swan sort of way of thinking about life, right? That
Yeah.
life is dictated by the extremes, not by the middle. And from that standpoint, that's why I keep going back to conditions, right? The conditions under which extremes can happen. I think that sort of mindset works. And I think, listen, the more you read, the better off you're going to be.
Yeah.
I think, unfortunately, in today's world, people tend to only read things that confirm their existing way of thinking. If you really want to educate yourself, you've got to expose yourself to as many different schools of thought.
Mm-hmm.
And realize that not one is going to be the perfect, strategy or way of thinking about markets, but, sort of the mix of things is how you should really view anything that has to do with your hard-earned dollars.
Absolutely. I agree. Thank you so much for coming on and spending part of your Saturday with us. Mike, thanks so much again. We'll be in touch, and we'll see you guys soon.
Much appreciated. Thank you.